Hello, welcome to another edition of Reyker Jargon Busters. My name is James Chu. I head up the Market and Investment Unit in Reyker. I also look after development of structured products that is distributed through our sales team to advisors and clients. Structured products, one of the things that has been happening in recent years is that people start to use more than one underlying indices or stocks in the structured products. I want to talk a little bit about this in the next few minutes about this feature. And this is what we call a worst of feature. What does it mean? For example, let's take a structure that pays a regular income every year or every month or every quarter, but it's linked to three different shares, A, B, or C. Usually, in the brochures or the terms, you see that the amount of capital you get back at the end depends on the performance of three shares. And if the worst performing share has not dropped below a certain level, typically a barrier, then you get all your money back. Here's the thing, the worst performing share or the worst performing indices. These are all worst of strategies. Another typical one is like you have a kick-out plans linked to 5 different stocks or indices, and the kick-out is only triggered if the worst performing stock or index has not dropped by, say, 20% at the end of the year. Again, worst performing. The reason why I want to talk about this today is that a lot of clients and advisors got a little bit confused because when they see they got 5 different underlying stocks, 3 underlying indices, or 2 different indices in the structure, they actually did not pay attention to the worst of feature. Remember, it links to the worst performing underlying assets or indices. It's not like a diversified basket of 5 shares or a diversified portfolio of 3 indices where a good performance of one will offset the bad performance of another one. No, you actually look at just one of them, the worst performing one. Therefore, worst of strategies actually is not a diversification. It's actually a way to take risk and basically have a very specific view. Go back to the 5 stock example I have. I said there are 5 stocks there. If none of them have dropped below a certain level, a kick-out is triggered. What's the view? The view basically is that you actually are positive on all 5 stocks in such a way that you believe none of them will drop more than that level, let's say 50 to 20%. So it's not diversification, it is actually a very specific view. Please be careful when you look at all brochures on structured products when these words of strategies are there. If you got any questions about structured products, all the different jargons, etc., always first go to our website, which have different educational videos and articles on that, or feel free to call our team. You can find the number here on the screen, or email us at sales@reyker.com. Thank you.